save the best for last, and we're going to try and go out the bang here. The final panel is going to be on collateralizing stablecoins using real-world assets. So Xavier has assembled a fantastic panel. Xavier from Invio. Please, it's all yours.
Hello, everybody. Thank you to stay for the last panel. I think the most interesting panel for Stable Summit. Let's applause my co-panelists for this interesting panel. Raymond Ye from Blue Jay Finance, Assad Khan from Centrifuge, and Sam McPherson from Felix Labs. Thank you, guys. As I mentioned, I think you are, some of you, veterans of stablecoin, crypto, and DeFi. Let each other introduce you and what is your relation with this panel. Sam, please.
Yeah, so veteran in DeFi, I don't know what the qualifications are for that. So my background, I co-founded Phoenix Labs fairly recently. We are focused on building out Spark protocol, which is a lending market that's in the MakerDAO ecosystem. Before that, I did smart contracts in MakerDAO in the protocol engineering core unit. So operating within the DAO, building smart contracts that were used within the core protocol, maintenance, that kind of stuff. I guess more broadly in DeFi, I've been in the space first as a hobbyist since I came in 2017, bull market, just hobbyist investor. I think as a lot of people kind of start, and then became more and more interested in the technical side about how it works, and joined MakerDAO, what was that, August 2020-ish, working for the DAO. Kind of a unique path in that I didn't work for the Maker Foundation. I was like one of the first smart contract developers to work entirely under the DAO. And back then, I mean, DAOs are all over the place now, but it was really, we were really bootstrapping the whole DAO process. So, yeah.
Thank you, Sam. Claude?
Hey, my name is Claude. I'm a co-founder and CEO at Mimo Labs. We're working on all things stablecoin, but more recently, we really specialize on real-world assets. I mean, what we're focusing on. And we have a form of a protocol that we call Kuma that essentially acquires debt from a company perspective and sells it on-chain in the form of NFTs and interest-bearing stablecoin. So essentially, like the panel of today being like backing stablecoin with real-world assets is pretty much what we're doing all day and night. So yeah, that's why I'm here.
Thank you, Claude. Assad?
Yeah, thanks for having me. My name is Assad. I'm with Centrifuge. I've lost, unfortunately, a lot of money in crypto, so I've paid a lot of attention to the places I've lost money, and it's stablecoins, right? I do business development and partnerships, the DeFi space for Centrifuge. Centrifuge has worked really closely with MakerDAO. We've been guided by Seb's French accent for years on how he thinks about things there, and that's kind of a big part of what we do. We're really big believers in stablecoins, big believers in real-world assets and stablecoins, and that's why we're here. It's been a really cool day of talks and conversations, and I'm incredibly jet-lagged, so if I fall asleep, I'm sorry.
I'll wake you up. Sorry.
Do not worry. Do not worry. You wake up. Thank you, Assad. Raymond?
Hi, everyone. I'm Raymond from Blue Jay Finance. So I'm a CTO and co-founder there. I have been in the space in 2017 as a hobbyist, doing MEV arbitrage trading on the side. Formerly got into the space in 2 years ago, and that's where we started Blue Jay Finance. So what Blue Jay do is that we actually help investors. We are a gateway for investors to get access to private credit deals, or rather private investments, placements. So basically you're looking at assets around the world where basically you can get yield from. Now, on the other side of the market, we also help businesses in the real world get access to capital, from the decentralized space as well. So really excited about the whole development of the real world assets. Big fan of Centrifuge. Yep.
Thank you, everybody. Thank you to my co-panelists. The ideas of this panel is clearly to evaluating real asset collateral helps to lower overall risk. We talk about risk in crypto and stablecoins since the beginning of crypto winter. Also managing capital inefficiency and centralized point of failure, introduced by real world asset also, and onboarding users and institution to DeFi via the integration of this real world asset. Because this is the idea at the end of the day, to have a real client and user of the different protocol and services. How does collateralizing stablecoin with performant real world asset contribute to lowering overall risk compared to other collateral options?
Well, I mean, okay, I'm going to start. I mean, like, yeah, I thought you were going to start because you come from Maker, but I'm gonna start. Gonna take a stab at this one. I mean, again, that depends on the original position where we stand. But if we consider that, again, like you have a stable coin that is only backed by like one type of asset, like only let's say a virtual asset, or only like a centralized entity and all that, you as a user do not really have much options to see like what's behind, and there is only like one type of asset that you see behind the stablecoin you're using. Having stablecoins having real world asset on chain could enable like the stablecoins to be backed transparently by different sorts of real world assets, and not only the reserve of Circle or the reserve of Tether and stuff like that. You could have something that is lowering the risk of putting all your eggs in the same basket. And like from like decentralization perspective, I think it's a step forward. Of course, those companies bringing real world assets on chain are all like somewhat centralized, but as it you rely on multiple centralized companies instead of one. I mean, at least you can. So that's again, that's one way it can do something better. And again, like you mentioned, like performant real world assets. It's if we call performant real world assets like real world assets that have yield, then you can limit the risk of having unsustainable stable coins. Like you can have like, essentially room based of the yield, that room to pay your salaries of people working on stable coins. You can room to pay the users and the marketing fees of whatever you want to grow. But essentially you can have like sustainable infrastructure. And that's something, again, what they step forward in our industry.
Yeah, it's a good answer. And to add to that, so
Claude.
to add to that, I'd just like to say, like, if you really, if you really stop and think about it, like, what are the assets that are not real-world assets? And at a large scale, there's really only one in the Ethereum ecosystem, that is ETH and staked ETH, and potentially L2 tokens and stuff like that for the scale of something like MakerDAO or larger to collateralize positions. So, and there's no reason that the demand side for the stablecoin should balance on those who are primarily taking leverage right now. Why should that match? And so you come to the inevitable conclusion, if you want to scale, that you need real-world assets. And I think a lot of people look at stuff like USDC, USDT. Those are real-world assets. Like they're just have the biggest demand right now. There's but like there's a whole sea of assets out there, and so if we were not to use real-world assets, like we would just forever remain this sort of niche thing with no connection to the real world. So like to be able to grow and change the whole economic system, it's not about do you back yourself with real-world assets. It's more like you have to, and then deciding what is the path to take that is safe depending on the protocol you're running. So for Maker, being a US dollar stablecoin, which is attaching itself to a real-world asset, the US dollar, you are by necessity going to have to back yourself to some degree with things that look like cash, US dollars. So the obvious answer to that is T-bills. So that's, and especially as of now, that's giving a very nice risk-adjusted return, as it's essentially the risk-free rate of the underlying asset, which is the US dollar. So if you have a stablecoin that's pegged to something else, there might be a different equation here, but ultimately, especially if we're pegging to things that are in the real world, and maybe the term real-world assets is not the best, but whatever, we'll stick with it. You need to have something that looks like the underlying. So by necessity, that means you need to tokenize the things that exist in the real world, and then it's the stablecoin issuers job to balance that risk and reward.
Yeah, I mean, I would even take it further, actually. Like, if you're a stablecoin that doesn't have a real-world asset strategy, I think you're just irrelevant, right? You're absolutely doing nothing for the space. You're creating an environment where we just kind of decentralize into oblivion and stagnation and irrelevancy, and you leave the door open for people like BlackRock and JP Morgan to come in, and
You don't like
they'll be hosting the
traditional
Stable
finance?
Summit 3 years
You
from
don't
now.
like Web 2?
Yeah.
Come on,
And
they have the money.
And I don't think that you need to sacrifice the principles of your stablecoin to engage with real world assets, but you need to have a strategy, and you need to understand that I think what Sam said really well, you're never going to be able to scale if you can only rely on the markets of ETH and staked ETH, right? And those might be great markets with incredible activity, and I think they have a huge role to play in serving stablecoins and honestly creating quite a bit of utility, right? But they're not the place that we can stay, and they're not the place we can stop. I equally also think that treasury bills and treasury assets are fucking boring as hell as well. So, we'll get to that part of the conversation too. But like the basics are, we have to have this stuff. Otherwise, what the hell are we doing here?
Maybe I'll just merge both of your argument. I think there's a stance somewhere in there that makes sense for both, right? I think the question right here is risk. And when we talk about risk, usually we are talking about portfolio management as a whole. How does my various different assets perform in relations to one another? So correlation, covariance is a big factor in there. And now if you actually look into a lot of the stablecoin provider out there, they actually have a whole basket of like goods that is entirely correlated. And if you look at the episode around USDC right now, you can actually see how all of the assets underperform, or rather be very correlated with USDC DPEG at the same time. And that is because like we used to think 2008 financial crisis is something a black swan, but actually there are things to be learned there, which is a lot of assets are very correlated when moving downwards. And during the during the time where market is being stressed, basically you are looking at liquidity being pooled, because as a market maker, it does not make sense for me to continue to provision liquidity in this space when things are moving all around the place. So for stablecoin, that makes it even more important to have things that are basically not highly correlated. And I think real world asset actually give that a good mix around it. And with any portfolio manager, right, at the end of the day, it's about what is the goal of this portfolio, right? Because different portfolios, for instance, like an income fund, right, would likely do money market, right? And their benchmark would likely be the T-bills, that sort of funds. And then it makes sense actually to have the portfolio say, okay, I'm majority going to have like different durations of T-bills based on, let's say, the liquidity requirement of my fund. But if, let's say, my stablecoin is more like inflation resistant, a bit of hedging against the US market performance, then it does not make sense for my portfolio to be fully comprising of only US dollars assets altogether, right? Or I shouldn't have, I should spread it out in different markets, not just money market. Right now, what I see is that a lot of protocol, at best, they extend to money market, but nothing beyond that. There's no real world asset allocation. There's no stock allocation. There is no, basically you get it, right? No equity, all of those things. Now, if you want your portfolio to be resistant, then basically having introduction of all these things would actually lower the overall risk of this portfolio, because at the end, your stablecoin is really just a portfolio, and the coin itself is just basically the stocks issue on that. Just think about it as an ETF. So I think both of your argument make sense, right? If I'm looking for a dollar money market strategy, then obviously it makes sense for me to have T-bills within my portfolio mix. But if something I'm trying to do inflation resistant, definitely more than that.
I think that's interesting that you call like a stable coin essentially like a token that represents a share of an ETF in a portfolio. Because it's even though it has some truth in it, there is also the inherent concept of returns in a portfolio that we expect. Most stable coins do not provide them, so that's a thing. I mean, I think this is why we're having this conversation.
According to you, this is a problem or not?
Well, I mean, it's more like it's not necessarily a problem. It's more of a definition thing, right? If we're saying that, well, it's like the share of an ETF, except it doesn't provide return, then it's not really like a share of an ETF. This is why I thought this is pretty interesting. But the reason why I'm bringing the point is that it's only because we have RWAs inside that now we can even consider that this could be like an ETF, because this could have returns. And stable coins could therefore be, pretty much like shares of an ETF. That could be a very interesting proposition. So I think in what you're bringing, like can stable coin be backed by reward assets, and can he lower the risk? Well, in this case, it could be something pretty cool, because the risk can be represented by the yield, and then we could have something pretty interesting and essentially consider stable coin to be like, shares of a portfolio.
So definitely advocate for returning yield.
Good answer?
Good answer.
Yes. It's good answer. Yeah. Thank you. Definitely a fan of
Good needers, some support.
of stablecoins offering a yield to the holders who bear most of the risk. I'd be hesitant to equate it to an ETF though, because owning a stablecoin is not the same as a deposit. You have no guarantee of redemption. So I think that's an important distinction I want to make.
That's an interesting thing. I mean, again, like we're making a stable coin that gives return to the user. So I'm obviously biased in this direction. Just want to say that, like there's also Circle that exists and they're not dead yet. So it turns out it's not like what everybody wants. Yeah.
I actually think the distinction, whether it's a deposit or not, right? I think that's like very academic. Back in the day, before banks just became like compliance functions for ensuring the man got his like 10 cents worth, right? Our grandfathers' banks, our grandparents, financial institutions used to actually provide like a level of risk and provide some sort of profile that would meet different needs in the market. And I do think that's what all of this is, right? We can talk about decentralization and principles and crazy ideas and rebase yourself to death or whatever it is, but you have to provide utility to users, and ultimately you have to provide different profiles of risk for different users in different markets. And the way to do that is on the balance sheet side of it. And whether that's collateralizing the stablecoin, that's creating markets where users hold assets or trade them against certain assets in your stablecoin. That's all the aggregate balance sheet, right? Yeah, exactly.
Yeah.
Exposure to bridges, exposure not to bridges, right? You have to make these decisions as a stablecoin provider or organization or decentralized individual contributing to a not security thing.
Yeah, I think at the end it's really just a not security thing, right? And you're just trying, as a user, you're just looking at the balance sheet and then looking at my assets that I'm holding. Is it matching the AUM there, right? You can say that I slow the way that I return assets back to you by rebasing slowly. But at the end of the day, the user is going to discount that by duration. They are going to see, okay, if you're going to give me my money back in 4 years, then I'm going to sell this off in secondary for whatever that I think the forward rate is going to look like in 4 years. So the asset itself, the pricing, might not be what you think the asset is redeemable for right now, might not be what the asset is truly worth to someone's holding it at the end of the day.
And that's what makes a market, right? Like, as prices move around, that some people take, both sides of the trade, right? That's what makes a market at the end of the day. Maybe you don't need a ratings agency. Maybe price is enough. I don't know where the ratings guy is, but...
Hot take.
I would like to come back on one point mentioned by Assad. When you talk about BlackRock and JP Morgan. No, it's a stupid question, sorry. I will put a stupid question for all of you guys. Don't you think at the end, for mass adoption, about collateralizing stablecoin adoption and so on, the best promoter are this kind of actor, JP Morgan, BlackRock, because at the end of the day, we know how human being works with a FOMO. If BlackRock go on this business or make that, even they're wrong, they don't have the good guys, the good tech and economy, what you want, most of people will trust and they follow. What do you think?
Just because I initiated this conversation, if BlackRock and JP Morgan came to the table and were creating really useful tech that was really pushing the needle on financial market infrastructure, solving real problems that are fundamental to, honestly, the globe at this point, right? And I would personally have no issues. People might kill me for it, I will call Larry Fink daddy if that's what it takes, right? But at the end of the day, the people building that stuff are in this room, and except for Xavier, none of us are really bankers, right? You know, we're techies. And I look at people like Sam, and like, we need to be able to build this shit together. And I think the things that Maker's doing is a great example of why those guys won't actually do it, because you need to take risks, take these ideas, and develop them in a market where you can be tested, right?
Yeah, I think it's important to be clear, though, like not having them run the show, but if they were one of many contributors to, for example, DAI being a RWA arranger or something like that. But again, one of many, because like otherwise, what are we doing here? It's like it's got to be decentralized, or else we're just reinventing the banking system. So
I mean, again, what you're asking is centralization going to be necessary for global adoption of stablecoins or the industry? So far, I'm not sure. I actually pretty much disagree. Like the most popular crypto out there is still Bitcoin, and it's like as decentralized as it gets. So like maybe it will help for the adoption of stablecoins to have big labels that people can recognize. Like, oh yeah, well, you know, the BlackRock is there and this and that. But it turns out when you do real world assets, you can have even the Fed behind your coin. Like it's already a big name as well. You know, you can promote those things. You have like even bigger name that those organizations that will at the end of the day play no better role than a middleman that, you know, like will not necessarily add that much value. And I understand that it could have some impact on the marketing on solutions, but I'm not sure that they will have a tremendous impact in bringing the next billion people in the industry. Like it will be innovation, it will be yield, it will be, I think like it will be more on what can you do with this, or maybe what can't happen once you hold this, than who makes it. Like we're not there yet, or maybe we will not be there.
Can I ask though, Claudio, just really, you know, the most used stablecoin today is USDT, right? The most attractive digital asset might be Bitcoin, but on the other side of that, USDT offers none of that, no yield. It's all centralized, and I don't think there's any innovation there in reality.
Yeah, still, but I mean, again, like I'm talking about what would move the needle from there, and again, like USDT, I think is a good example of the anti-label. Who knows who's behind Tether except for people in this room? Like, and nobody. Who knows what's inside of this? Nobody. Yet, I mean, it's something that is centralized, but for most people, like ever touching USDT, it has like the same level of opacity as Bitcoin. Like people have no clue what's inside and this and that to them. And yet people use it, and it's the most used stablecoin, right? So I think the whole thing about labels and all that might not be as necessary as it gets for the growth. At least so far, this is not what the space has shown us.
wouldn't it be great if there was a stable coin where you could see what it's backed by all the different assets, right down to the end borrower, all on chain, all completely auditable, right up to the second?
That's pretty much what we built. Thank you for pitching.
Actually, touching on that point, I think it's interesting where, you know, the crypto community is always talking about, you know, full transparency. At what point do we want to stop that? Because at scale, not everything can be completely transparent. And I think even with MakerDAO, you have created a new organization where basically you invest in deals that, you know, you cannot fully describe what the deal intrinsic detail is about, because some of them could be trade secrets, right? So some of them, I mean, at the end of the day, if you're doing investments, it is what you invest in that gives you the alpha. And sometimes you don't have to share that.
Yeah, I can respond to that. So, you know, I'm from MakerDAO, but I don't necessarily agree with all the deals that were made. I'm a much bigger fan of tokenized public markets, public credit, because like those are huge. Like we haven't even begun to tap those out. So doing more bespoke private credit deals, I'm not a big fan of. So I'm like, let's exhaust like the public markets, so then you don't like there's not these issues about like opaqueness and stuff like that. Like, you know, T-bills is a huge market. Like we're just not even cracking the surface there, and like there's a whole world out there. So yeah, let's exhaust that first. And yes, personally, I agree with you. Advocate for transparent public credit.
I wholeheartedly agree. I think we built this industry on a couple of things, transparency being one of them. And maybe like not being transparent can still work, as we've seen, you know, like a non-transparent solutions did work. But then again, like you still have a choice, both when you buy an asset or when you create the asset. Like then I guess we're talking about personal preferences here, and the market seems to be okay with both transparent or not transparent. I would personally just join like what our friend said here. Like transparency is still good, but then again, like I don't think the market has forced us into this. But I still think this is more of a culture thing. Like we have a culture in the industry that is a culture of transparency. Maybe actually this is a bigger question. Maybe the non-transparent, the lack of transparency could lead us to something bigger because there's a lot of organizations that would adopt crypto only if it was not transparent, maybe something like that. But at the end of the day, for what we have now, I would hope that we can go as far as possible with transparent solutions.
Great, but you get a good answer, Raymond? With MakerDAO, I'm not. Very interesting point of view, guys. Thank you. And I have a question regarding collateralizing stablecoin with performant real-world asset. Do you think, except T-bills, because you talk about T-bills, do you have other eligible real asset to collateralization?
Yes.
Good.
Yeah, no, totally.
Bad assets, terrible assets.
So like T-bills are the obvious one because it's like as close as you can get to the underlying, which is the US dollar. So for DAI, but there's tons of other stuff, but it gets, there's kind of like two camps. There's protocol controlled value, which is stuff that you want that basically won't lose value to relative to what you're trying to peg to. So this is like basically like T-bills and like, you know, AAA bonds, this kind of stuff. Stuff that's like super safe as you can get to the underlying. Then there's user vaults, which is volatile compared to the underlying. So this would be crypto vaults would be one example of this. But there's no reason you can't have like tokenized stocks and stuff like that that's more volatile where you enable users to speculate on this in the same way that they speculate on the price of ETH. So yeah, there's all kinds of room here for all kinds of RWAs.
Exactly. I mean, as long as you have efficient liquidation strategies, as long as you have the infrastructure in place for it, there's no reason why you can only use one type of asset. It's then it goes down to portfolio management. Like, do you want to put all your eggs in the same basket? Is the goal of your stablecoin to generate yield? Is the goal of your stablecoin to be more of a betting market for people to long and short, take long and short position on volatile assets? You can do a lot of those things, and what will make something good or bad is more like how easy is it to liquidate the asset in relatively to how much you want to have of it, right? And that's why you might not want to do like a third world real estate for backing a stablecoin like that has a lot of liquidity, for example, because maybe it might not be easily liquidable, like easy to liquidate. But maybe like a lot of assets, like we're talking stock, we're talking like I mean, we could have money market funds, like we said earlier. We could have have debt. Again, like. I'm somewhat biased here because we're building a ton of stablecoins backed by different assets and want to have protocols use these stablecoins as like a part of their portfolios to build different stablecoins on the top of them. So like we do believe in an approach that you can have a lot of type of asset behind stablecoin, because at the end of the day, it just goes back to portfolio management. Like, what's the Sharpe ratio of what you have? And you just have, normal portfolio management. Like the whole idea of portfolio management is pretty old, and there's a lot of research and available information on that. I don't think like only T-bills is a solution that will cut it, because at some point people will want to generate revenue. When you want to generate revenue, you will want to have like something that pays more, and when you want to have something that pays more, you're going to have to do portfolio management.
So to add on to, I'm going to share some examples from Maker, right? So I know you don't agree with this, right? But Maker actually did quite interesting deals in the private markets. So one of the things that they do is that they actually have real estate involvements. They have trade finance involvements as well. And these are different, markets that you can invest in. And what is interesting with Maker is that they don't actually go into equity part of real estates. They take on actually the debt positions, if I'm not wrong, right? And that actually gives them senior secured debt on top of like the real estate equity fluctuation. So that means they won't be hit as bad or even hit at all if the real estate prices gone down. The same thing as with trade financing, with a lot of invoice factoring deals that you are also investing in. yeah, they are doing that, right? It's just something that Sam is not agreeable to, right? They are doing that. And these are actually collaterals that are interesting, right? That is also related to, maintaining a good, healthy DAI at the end of the day, because these are also debt position. But now, is it good? Now, the problem is not so much of, is this collateral good by itself? Because ultimately, there's no one collateral that is good by itself, right? You need to go back to how you are managing the portfolio. Am I going to allocate 99% of those things into real estate? Then, oh, I'm actually investing in a real estate fund and not really US dollars, right? Am I allocating 99% of those into trade financing? Then you should have just called yourself a trade financing firm, right? But at the end of the day, it's right down to your portfolio composition that is going to reflect on what is the ideal goal that you're trying to achieve, what are some of the downside and upside that you're trying to capture or avoid. So I think the conversation on what is a good collateral is not as effective as how am I going to go about compositing my entire class of baskets of goods to actually support what kind of ideology that I'm trying to move forward with.
Yeah, the only twist I'd add to this conversation is I actually think that as like a stablecoin industry, we're quite unsophisticated, right? We're obsessed with this like short duration idea that can be redeemed at any time, transacted at any time, and we think that's the only way to offer these products. And there's a lot of technical implications, and we're operating in DAOs, we're operating in crazy market environments. So I understand why we're so focused on kind of maybe what's right in front of us, right? But the reality is that it's balance sheet management, sources of funding, right? Composition of your funding and your liabilities and your assets. I mean, how many stablecoins even offer term deposits or anything like that, right? There's a few examples. There's protocols that are building ideas on top of other stablecoins. I think really in order to be able to engage the whole world of assets out there, you have to have these kind of ideas and these primitives built into your marketplace. You have to have sophisticated markets with buyers and sellers that are consistent and active and large volume. And you have to do so many things to even build all that up. And then you can really start to engage with the interesting things in the world, right? Until then, maybe treasury bills is enough, right?
Yeah, I completely agree with the liability. We haven't even really discussed the liability side, but yeah, term deposits, stuff like that. I would like to, personally, I would like to start exploring that more, basically having the users commit to duration such that you can match it in a more explicit way in the asset side instead of just guessing what roughly the users are going to do. But yeah, I think it's a cool primitive that's been underexplored so far.
I think it goes back to the last question about what happens when we bring BlackRock inside, right? Because at the end of the day, as an industry, I think the crypto is trying to draw a very clear line. It's like, we are the Web3 guys, and then Xavier is the Web2 guys, right? And then we draw, fat line there, and it's like, this is us and that is you. But I think how we are going to progress ahead as an industry is that we start to clear out the line, because if you look at the whole real asset narrative, it's actually the Web3 folks trying to get into the Web2 industry and melding that. And I think it helps when we can actually merge the two words and call it finance again, instead of calling it this is like Web3 and then people are Web2, because the Web2 folks certainly bring a lot of experience, especially in structuring, understanding asset liability, and also basically funds that are not immediately liquid. So when I was talking to people about illiquid funds and assets altogether, no one had an understanding of why do I invest in something that is 1 year. But if you go to any VCs, any funds out there, they're like, wow, what is this 1 year thing? Why is it so short? How do you achieve that? Because their investment horizon is like 5 years, that's shortest, and then 10 years how the funds usually run, right? So there's a lot of mismatch in how we run things that I think as an industry we have a lot to learn from still, from the so-called Web2 guys.
Yeah, I mean, there's a couple of things like we're of course it's nice and rosy to see that we will all blend together at some point. Let's not forget that there's also a reason why we exist, right? Like it's I go back to the lack of transparency. Like when you want to have access to a lot of the real world assets that are backing, like the stablecoin that we're building today. Those things, if you want to have access to them as a retail user in your bank, you just won't have access to them because there's a lot of gatekeeping work and a lot of things like that that we as an industry have decided collectively to break. And it's not as rosy as we all work together. I think it's we're still kind of like stomping on their feet a little bit. They will not be necessarily as happy as that to work with us, but. Man, we become their customers at the end of the day. We become another customer than the retail users that they're trying to gatekeep from a certain category of assets. And I think this is, again, there's a lot of good things to happen from that, but it won't necessarily be a smooth path like towards working with Web 2 guys.
So I think the real world asset category of like DeFi is the rebels from Web 3 stepping forth to say, hey, we are going to start working with like the Web 2 folks. Now the question is, who from the Web 2 world is going to be the first rebel and step forward and say that, hey, this guy's really got something.
Wait, so we're the rebels for working with TradFi. I like it.
I thought we were all TradFi rejects. Is that not why you're here? Couldn't get a job. So,
Hey guys, how are you doing?
It's the last panel for the day, right? You got to make it fun.
You are not still drunk, so keep it easy.
Well, what did you put in the water?
Just a vodka, I think so. But anyway, no, very interesting. And in your different companies, how do you see the adoption? Because today, to be honest, this is a niche. We need to accelerate in order to cover some stuff such as financial inclusion, liquidity to small people and so on. How do you work on that in your company in terms of mass adoption?
Well, this is again like if we want to talk about mass adoption of in the specific context, mass adoption of stablecoin backed by real-world assets. It will be like, I think it's just capitalism that is the answer. If a stablecoin has more treasury and has productive treasury and can make more money to become promoted easily, like to have better staff, to have more growth, then it can grow. I think it's just like they can even decide to pay the users and stuff like that. So money will find its way towards like making more money. And at the end of the day, as he was saying, like if you don't have a strategy about real-world assets, or even if you don't have a strategy about like making more money at the stablecoin company, then you're just going to be eaten by somebody with a better strategy to make more money than you. Because if the stablecoin is a commodity, then it's about who can make it more efficiently, right?
I think the question is going down to the topic of governance, because when we look at the Web3 DAO, so traditional company, you elect a CEO, right? You elect a management team to actually make smart decisions for the rest of the folks, right? And in the Web3 space, right, we talk about trying to distribute equity to the masses. But the question is through the liquid democracy, the right way to run things around here, right? Because does that lead to good decisions, especially around finance, right? Where it's something that is a little bit opaque, a little bit hard to grasp, and there are some easy things that we want to reach out for. We want high yield, we want high liquidity, we want low risk. But quite frankly, how do you get to that mix, right? You need some trade-off somewhere, so someone needs to make that decision, right? And I think that the answer does not lies with the masses. And I think Maker's DAO structure is interesting, but is there other structures that we can explore that actually allow people in this space to make decisions collectively that is optimized for everyone, rather than like, I'm optimizing for liquidity and pricing, and then maybe I actually forego a lot on risk, right? I'm super exposed on long tail risk, and it's only until too late that I realized that, hey, actually I should have done more in that space instead.
Are you advocating for re-centralization of our world? Like, I think like
I think it's a big question, right? Because it's like, is democracy good?
Yeah, no, I mean,
no answer to that.
I think it's not So what we're building in building these whole DAOs and all that is not necessarily that we have a whole democracy, because it's not everybody that can vote. It's just people with tokens. So essentially, those answers are going to be solved by the market, right? Like if one a token has a bad risk management strategy, another DAO maybe has a better risk management strategy, people will vote by the tokens of that and then grow. So essentially, you have, by effect of having the choice, the possibility of splitting governance. Then again, I mean, we can also talk about different governance models. Like maybe we can make like a DAO that elects 5 people that are, like top economists and stuff like that, and those guys make decisions. That could be something that exists, and I'm fairly confident it's eventually going to happen. But it's still like at the end of the day, we have the luxury of having a market that defines like which governance model can work best.
Yeah, I mean, I think the stablecoin market is really the most interesting place where this whole thing plays out, right? Not just because adoption is useful, because stablecoins are useful for users in the marketplace in the first place, but you also are starting to see this really a wide variety. I mean, the panel earlier had like 6 different perspectives on what a stablecoin was and how to go to market with it. And so I think from like a real world asset perspective, to us, it's about like doing the basics, bringing these assets on chain, like integrating them with DeFi protocols, making it so that they're useful at the interface level in the way that like crypto native protocols can really use them, trying to build like, legal solutions that they can trust, and trying to build transparency in when we can, right? So ultimately that different stablecoins can kind of choose to select these different strategies, implement different things, do it with a tech-based advantage, and the market will price it out and kind of choose which users want, right?
Yeah, we need more primitives.
I mean, that's again, like, I don't want to do a shameless plug, but that's exactly what we've been like striving to do, like where we're working. Like, we did not want to build just another primitive that could only be used by 3 people. We worked like night and day with regulators to try to make like a permissionless real-world asset kind of thing, which can therefore be used by different protocols. But I know it's still rare. And again, like once you did all this work, you need to get the word out and all those things. I think it's hard, but it's coming. Like when we came out with whatever we've built, we realized that other people are coming out of the woods with pretty good stuff, and fairly confident that we will have more Lego bricks to essentially like build a nice like DeFi world. And yeah, this could lead to more adoption, hopefully.
But do you believe the regulator will give in the future a framework? Because at the end of the day, if, as mentioned by Raymond, it's a question of government. If you and we are agree, at the end, we don't need approval of outside
a regulator. That depends on which part of the process we're looking at, right? From the tokenization layer, and where you still need to integrate fiat into a system to buy the real world assets, are going to do the whole thing. Regulator still needs to work there because we still have these money laundering issues and stuff like that. So only at that level. Then whatever comes after, like the portfolio management strategy and all that, hopefully all these things can be done on chain, and this is why we're all striving for here, I guess.
Yeah, and regulators, like there's not just one regulation body, there's many countries. So they face a prisoner's dilemma in that those that are gonna just reject the space are gonna be left behind economically. So one by one, you'll see countries that are more favorable. You're starting to see it now, that are being crypto favorable. And I'm definitely a fan of regulation that makes sense, but not overreach. Let the market play out, but protect people from the scams and the Ponzi schemes as best you can. So this middle ground approach, I think we're going to see more and more countries doing this, and the others will be forced into it.
What we, to me, sorry, what we see as, in my opinion, something that is good in terms of middle ground approach is when regulators focus on transparency and disclosure requirements. Essentially, like, well, you can do X and Y as long as people know what's in the box. And once you do this type of thing, like, you have a much easier conversation with regulators, because it's about, okay, well, make sure people know, make sure it's like clear when people take a risk, make sure it's clear when they don't, make sure of those things. And I mean, again, we're regulated in Liechtenstein, which I believe like so far has been pretty progressive as a regulator. And like we're seeing Hong Kong making good steps in this direction. Again, like regulatory shopping is a thing in crypto. People really understand it very well. And it's not going to stop tomorrow. But again, some regulators are pretty progressive on that. And I think it's going to be pretty convenient.
No, I mean, I just hate the regulatory topic, right? Hug your local regulator or something. I don't really know, right? But there's different products that exist today already that are making this happen. You don't think we need to wait for regulators, right? There's Back, there's Swarm, they've got different approaches. Centrifuge has its own approach, Maple's got their own approach, and they're all working today, and they all have different opportunities associated with them. It's the market's market, right?
Clearly, this is nearly the end. If one word for the audience, last word for each one, if you want to share something with the audience. No?
I don't know. I'll just stress on portfolio management because I think we don't understand the dynamics of things as they work with each other. A lot of time we are too focused on the individual one thing that is within the balance sheet and overlook how that one thing plays well with other things. So I'll let them take away with that.
Thank you, Raymond.
I just think your stablecoin needs a real-world asset strategy. And if you don't have one, come talk to me. I'll give you one.
Thank you, Asad.
Yeah, I would say, given that not all stablecoins are made equal, it's just the same with real-world assets. We're talking RWA, but it's not all real-world assets are made equal. And even though you have a real-world asset strategy, well, I mean, transparency is going to be the key. Please look inside the box. This is why we're building this industry. We're making sure that things are transparent. So please take the time to look before you cry because your token goes down to zero and it was written in the doc that it was going to go down to zero if X and Y happens, right? I think we have the possibility of making much riskier stablecoins. We can make super risky things if we do crazy portfolio management, but we could have crazy yield from that. And essentially, we have a room. We're talking stablecoin with T-bills from the beginning of the conversation, but we could go much further into bringing stablecoin backed with super risky things. And I think it could still be somewhat kosher as long as it's written on the box, right? And I'm pretty sure this is going to happen because people will go for yield. It's just that at that moment, when you see something that pays, please look where the yield is coming from. And even if it's a real world asset, it's not because BlackRock is behind something that it means it's safe. It could be BlackRock making a crazy option strategy that pays a ton and still have something, therefore a ton of risk, right? And it would be a good label, but high risk, and you would still put money in it and then cry when you lose. So it's, believe in the transparency, look into the real world assets. They're not all made equal. That would be the main thing I have to add.
Thank you, Claude. Sam?
I don't really have anything inspirational. The future of France is alive and well.
Fuck yeah!
Amen.
Thank you very much to all of us. I think we have the time for questions for the audience. If you have questions, do not hesitate.
I think the thing that we haven't talked about a lot today is that you need to create liquidity in USDC. You need to pair against that and provide an ability for your lenders to be able to access that. Because at the end of the day, if it's real world assets, they're going to want fiat and USDC, USDT. Those are the avenues for getting there. So that's step one in my head, right? And I think there's others, but that's to me a big one.
Yeah, I mean, I think we're actually getting there. I mean, Maker's scaling pretty rapidly up with the T-bill investments. So, and that's almost infinitely scalable compared to the size of crypto. I mean, it's not infinite. We will tap it out eventually, but that's a long ways away. So just getting more and more of these very safe investments on chain, ideally tokenized with liquid secondary markets would be ideal. Just keep building on that. But I think we're already through the door.
Yeah, I think it's sorry. Okay, I think it's about either you create new stablecoins that are backed by real-world assets, and in which case it's a liquidity problem. So then how do you solve that? It will mean yield somewhere. So then you can incentivize trading and have incentivized curve pools or get good market makers to play ball with you, which you can because your assets are productive. So then you have budget for that. So that will be the step. Or you work with already established stablecoins, and then you compete against whatever is paying them right now. So then it would not be about growth of new stablecoins with real-world assets. It will be more like growth of real-world asset inside of existing stablecoins. Like there's two ways to answer the question, and I think in both cases it goes down to yield.
So it depends on how you define scale, right? Because if you are looking at 2x, 3x scale, then whatever that you are doing, just do more of, right? But if you are looking at growing the industry like 10x, 100x, it requires a fundamental revamp of the whole plumbing. In fact, starting from liquidity, USDC would not cut it. Don't add Ether in there, right? So it just doesn't cut it, right? They don't have the capability to provide that level of liquidity, the matching, to actually trade against it. So it's not just about the asset scaling side, but also on the liquidity scaling side. Can I actually introduce like $2 billion worth of assets into this space tomorrow without moving the needle? No, it's going to completely trip the market cap over. The price is going crazy, and then like everything's going to be lost to slippages and all of that, right? So that might require a rethink about things, and I'm afraid, right? It actually requires regulatory, to work the government to work on this, right? So that BlackRock and the likes of it can actually come in and say that, hey, I can actually professionally market make for you, and I'll use my name as a guarantee. I use my asset as a guarantee, my balance sheet as a guarantee, to provide this service altogether. So that level of scaling is slightly different from what we are doing right now. What we can do right now is we can go 1.5, 2x, 3x, and from there, I think at the end of the day, it's really trying to see how we can use this as an experiment to prove to the rest of the world that this is actually a worthy endeavor, and then basically to get the bigger player in, whether it's capital, whether it's other sorts of resources, to actually scale that 10 times, 100 times.
Thanks. Maybe more tactical or lower. What technical problems need to be solved to help you reach the growth goals or timelines that you have?
Pricing. It's like easy to price T-bills, right? But becomes really hard to start pricing anything outside of that, I think, in reality. The more liquid it is, the easier it is to price, but liquidity is one of those things that changes across marketplaces, and especially once portfolios get interesting, pricing is a really, really challenging problem, and you can't just say throw oracles at it. It becomes all about valuation, what are you holding, assumptions, asset composition. And so that's a really very, very technical challenge in real world assets.
Yeah, for Maker, so we've done the first step of getting the direct exposure to T-bills, but the process is still fairly opaque. So the next iteration is going to be tokenizing these things, bring them on chain, and putting the entire loan book from end to end on chain, real time. And so when we have that, it's not like it's a technical barrier for anything other than, I would say, trust within the system. Like, we don't want to just recreate these opaque black boxes of before, right? We want to innovate. So the innovation is going to be with these Oracle pricing, actually similar to what Khan said. Yeah, the Oracle pricing, stuff like that, such that any auditor or any individual can just like use some piece of software and say, okay, this is exactly where all the assets are. The entire loan book is like the supply chain is on chain in some form, such that you can see. And we have it broken down such that the people who are posting this are all very independent actors, independent jurisdictions, independent, just lots and lots of diversity, so that this will just build the confidence of the stablecoin.
So I'll add on to the pricing, but there's actually one other thing that is very important, which is legal structure. I don't think the industry has got around to it. Also, primarily because the government, made it extra hard. So even if you look, the bigger the organization is right now, the more complex the legal structure look. I mean, if you take a look at Maker, it's rarely just one corporation itself, right? And the problem with just a balance sheet, a consolidated balance sheet approach is also that, yes, I can list down my asset and liability in a consolidated balance sheet and everything looks good and rosy. But here's the thing, right? If your legal structure actually puts assets on one side of the thing and then liabilities on another side, right? Basically creating what you known as maybe bankruptcy remote entities and all of that, then basically in times of stress where one of the, the liability is still there, your asset value drop, doesn't mean that you can use actually the asset to actually net off the liability as well. So a lot of my challenge day to day is also understanding like the legal structure around how to create this kind of thing. And I actually urge people to go beyond like just what is on the balance sheet, but figure out what does it mean when you hold these certain things in this, on your balance sheet. Where do you hold it? What kind of like claims do I have on it? Is it a senior claim? Is it a junior claim? If it's a senior claim, who is more senior? If it's a junior claim, how am I going to be affected by like other senior debtors on this? And then like basically the legal structure. And it's not simple, right? So this whole thing is very complex.
I would say that essentially there is, regulatory, like low technical regulatory steps to be achieved in order to help. I actually agree with the difficulty of auditing the different seniority or different type of debt that you could have behind real world assets and stuff like that. But there is, if we really want to stay purely technical, there is, I think, something to solve in two places. One is the interface of whatever users would be using, because if those stablecoins backed by real world assets are better, it needs to be communicated somehow to the end user at some point. So, like, how do we, technically speaking, like, how do you represent the transparency? How do you make it clear to the user that this is better? This is going to be like a piece of work for people like building wallets and stuff like that. If they want this thing to grow, then like how, because most of the movement of stablecoin actually happens on centralized exchanges. How do you make like the stablecoins back, like the stablecoin used by centralized exchanges actually like we use real world assets that are on chain? So if we're talking about productive stablecoins that have interest bearing and stuff like that, how do you like leverage how do you make the tech of centralized exchanges work with interest bearing stablecoin? Like they're very far from there. Like the tech of most exchanges is more optimized towards trading and not for the asset management itself. They generally have big dump of the balances. So, if my token grows X% a year, his token grows Y% a year, and we put them like both on Binance today, like there's just no way for our assets to grow. They have taking programs instead, but it's very far from the actual tech of real world assets. So I think it's a thing where DeFi is way ahead of the centralized world. And from a technical perspective, centralized world needs to catch up before that happens. Again, that was only for a technical perspective.
Thank you.
Thanks to everyone for your presentation, fellow TradFi refugee.
Reject.
Depends on your perspective. What really distinguishes what all of you are doing from the structured products desk at BlackRock? Like what is really different than something that needs a disclosure regime, has a kind of basket portfolio formation process, creates it into a product that creates exposures that are different than the underliers themselves? Like everything you've said today, I haven't seen something that just jumps out as, oh, that's so different that BlackRock's just not going to come back in, or Citadel or someone's not going to just come back in and structure something that replaces it. That this isn't just the future of TradFi and you happen to be here early. So can some of you comment on things that really stand out as different from a
There's a couple things. First is transparency. It's more on what we try to build, as we've said a little bit earlier. It's about like trying to make what everything TradFi has been doing within a black box, replicating it in an open box in crypto. So those things are not sitting in, oh, that's fund A, and you put money in it, and this happens. No, it's this smart contract where all those things happen, and you can have a proper composability of things. We're thinking of things as primitives and Lego blocks where they can be composed onto each other. And this is something that, like, essentially, like whatever is built by BlackRock does not work. Like, it might have the same exact mechanics, but it's built in a totally open framework. And this open framework is also modifiable and composable by the user. Again, crypto, one of the things that crypto is programmable money. And it's like we're essentially just leveraging programmable money, and we can like issue new products like really quickly directly on chain without having to like go through an approval, go through a period of having an issuer of the product and all that. You issue a new smart contract. use primitive A, primitive B, primitive C, boom, boom, you have a new structured product. So again, what we say might sound like what you could see in a bank, except it can be done faster and more transparently. And this is why a lot of us like have worked in bank before. We understand like how it was done there, and we're like, maybe we can make this transparent and all that. But again, like this specific panel is about bringing real world assets on chain. So in the real world asset part, there will be a lot of overlap with what the real world already does. So I guess we first like match before we go further. The second thing that I think we're bringing is like the permissionless nature of the things. Like you buy something, again, the share of a fund at BlackRock, transferring it and putting it in another protocol, using it as collateral to borrow something, and then putting it in something else on DeFi is not really possible. With what we're doing, given that we consider everything we're doing as Lego bricks, we like see things as being as again like permissionless as possible, usable as possible within a concept of programmable money, easy to move, and as liquid as possible within the space of a peer-to-peer network. So it's again the back of it might sound very like again very similar to what has been done, but that's because we just didn't talk about all the things that crypto already offers. Because the assumption is that in a room everybody understands that, oh yeah, okay, that's what we do here, right? The composability, the nature of everything moves freely. That's the crypto part, and this part is where it's interesting. This part is the innovation part that, yeah, now BlackRock just doesn't cut it here.
Yeah. So all world reserve currencies also carry monetary premium attached to them as being a world reserve currency. So it's always been DAI's goal to be a credibly neutral world reserve currency. That is the end goal. You know, whether we'll get there, who knows? It's a pretty lofty goal, but this is the idea, such that people are free to use it, but nobody has ownership of it. Unlike fiat currencies can be used and abused by the states that are in control of it to inflate, to pay for various domestic policies at the loss of those who are holding it in as reserves in other countries. So the US dollar is the world reserve currency, the main one right now. So when they're inflating the currency, who's paying? Everybody else in the world who's holding it as reserve. So this sort of premium, this is the goal of DAI, MakerDAO, is to have a world reserve currency that everybody can share, and it's a public good for the world and not owned by any individual state or otherwise.
So my take on that is actually access. There's actually two parts to access, right? So one is actually physical access. Can I actually buy? Can I actually hold this thing? Now, if you look at BlackRock's product, right, short of the ETF, okay, maybe we will talk about ETF. How many people can actually get access to a stock market, the New York Stock Exchange, to actually buy the ETF? Actually, if you look at the global population, not many people have access to NYSE. That's one, right? And even if, let's say, you have access to NYSE, right, and maybe you are accredited investors even, right, that does not mean that you have access to all of BlackRock's products either, right? There are some products that requires a $1 million initial check, and I'm not sure how many people can have a $1 million liquidity right now to just pay off like just one bond or something like that, right? Not many people can do that. So I think one part of the industry is actually breaking down the access to actually allow people to have access into this, get it down. What I found out is that a lot of funds doesn't have a very good way to run the process of actually automating this kind of payments, and crypto did a great job at, I can do a mass payout to like tens of thousands of people, and it costs almost next to nothing for the one dispersing the funds. That's physical access, right? The other part is actually knowledge, the ability to understand this thing. And I think the approach that the industry take on this is actually rather interesting, because rather than going after the mind, people are going after the heart of the investors first, or rather the individuals, right? Basically, you get first-hand knowledge of like who you're dealing with, how you can serve them primarily, and then later on figure out what kind of products that you want to structure, what kind of things that you want to offer, and not just that. So you provide education, you provide different sorts of resources to help people get there. A lot of this value is in uplifting the individuals rather than like, hey, I'm going to sell you something in that sense. Now, this is something that, in fact, as we talk to funds, a lot of them actually have real trouble actually reaching out to the mass. And by the mass, I'm talking about mass affluence, so people of accredited investor status. So if you look at the statistics around, how individuals and how funds actually invest, actually 50% of all the money in the investment products actually comes from individual. But then if you look at private products, actually that's only 10%. So there's actually a huge gap around understanding, around access in that aspects as well. So even reaching out to a category known as the mass affluent, so not people who doesn't have money to pay for things, right? You also have problem because these people, number one, they don't understand the option strategies. They don't understand what is private credit. They don't understand a lot of things, how to run a VC funds, how to, get access to all of these things. All of this requires not just like, hey, I'm a VC fund, I'm trying to, sell you this thing, right? I actually need to do the due diligence to go through what this fund actually meant, what is the strategy, what is the risk behind it. And I can't do that to every individual looking to put 1K check into this. Right, but the industry is actually taking a flipped approach around how do I actually provide access to as many people as possible and flip it around, optimize on the cost, right, and then actually use the power of the masses to actually get into this thing. So I think that's a huge advantage that a big industry player will not be able to have even if they tomorrow decide to flip the switch and say, hey, let's offer this on that platform.
Yeah, big banks did it for the wealth. Crypto does it for the people. That's as simple as that.
All right, thank you very much. Big round of applause for our final panel of the day. And we know there's a ton of questions, so feel free to mob the panelists afterwards, right?
Thank you very much.
Thank you. That was a great way to end it. So this is the official end of Stablecoin Summit Day 1. We hope to see all of you back tomorrow. We've got an even better day planned for tomorrow, but we've proven we can take... Oh.